You are standing at your mailbox on a gray Tuesday morning. It has been 6 months since you sold your home. You remember the relief you felt when the deal closed. You remember paying off the mortgage, paying the real estate agent, and finally depositing the remaining equity into your bank account. It was your nest egg. It was the tax-free reward for 20 years of homeownership. The one financial win you were counting on to secure your retirement. You believed, like every other Canadian, that the sale of your primary residence was untouchable. You believed in the Principal Residence Exemption. But today, as you tear open a thin brown envelope from the Canada Revenue Agency, that belief is shattered. The document inside is not a refund check. It is a notice of reassessment. The CRA has reviewed your file, and they have used artificial intelligence to analyze your utility bills, your rental ads, and your transaction history, and they have determined that your home was not, in fact, your principal residence. They have retroactively denied your exemption. They have reclassified your life savings as taxable income. And because of the new capital gains inclusion rate, they are demanding 66% of your profit be added to your tax bill immediately. You are not just facing a tax bill, you are facing financial ruin. Welcome back to Canada Property Watch, where we expose the hidden mechanisms of the financial system that are dismantling the wealth of the Canadian middle class. We have walked you through the panic selling crisis, the penalty trap, and the nightmare of negative equity. But today, we are facing the final boss of the Canadian housing market. We are investigating the Canada Revenue Agency and the new aggressive audit campaign that is targeting the one asset you thought was safe. Today, we are exposing the principal residence trap and the 66% exit tax that is waiting for you after the sale. To understand why this is happening now, in 2026, we have to look at the desperate state of the federal government's finances. The government is drowning in debt. They need revenue and they need it fast. They cannot raise income taxes on the working class without causing a revolt, so they are targeting the largest pool of untaxed wealth in the country, the equity in your home. For decades, the Principal Residence Exemption has been the sacred cow of Canadian tax policy. It allows you to sell the home you live in and pay zero tax on the profit. It is the vehicle that built the middle class. But the rules governing this exemption are much more complex and fragile than most people realize. And right now, the CRA has been given a mandate and the technological tools to weaponize those rules against unsuspecting homeowners. They are not technically canceling the exemption. That would be political suicide. Instead, they are aggressively disqualifying homeowners from using it based on technicalities, change of use rules, and the new anti-flipping legislation. They are finding reasons to say no, and the burden of proof is entirely on you. The first and most common trap that is catching thousands of Canadians is the partial use nightmare. In an era of high interest rates, many homeowners have turned to rental income to survive. You finished your basement, you put in a kitchenette, you rented it out to a student or a young couple to help pay the mortgage. You thought you were being smart. You thought you were being resourceful. But in the eyes of the CRA, you may have just destroyed your tax-exempt status. The tax code states that to maintain the full principal residence exemption, the income-producing use of the property must be ancillary to its main use as a home. There must be no structural changes, and, this is the killer, you must not claim capital cost allowance or depreciation on the rental portion. Here is the scenario we are seeing play out across the country. A homeowner rents out their basement. They file their taxes honestly. To lower their tax bill on the rental income, they claim depreciation on the building. It saves them a few $100s in tax that year. It feels like a win. 5 years later, they sell the house for a $400,000 profit. They claim the principal residence exemption. The CRA computer system instantly flags the file. It sees that depreciation was claimed in previous years. This triggers a deemed disposition. The CRA rules that the moment you started renting the basement and claiming depreciation, you effectively sold a portion of your home to your business. When you actually sell the house, that portion is not tax-free. It is subject to capital gains tax, and not just the old tax. Under the new rules introduced in the federal budget, any capital gain over $250,000 is subject to a 66.7% inclusion rate. This means 2/3 of your profit is added to your income and taxed at your highest marginal rate. That basement tenant who helped you pay the mortgage, the taxes you now owe on the sale will likely exceed every dollar of rent you ever collected. You picked up pennies in front of a steamroller. But the trap goes even deeper for those who have change of use issues. Let's say you decided to downsize, but the market was bad, so you decided to rent out your entire house for a year or two while waiting for prices to recover. You moved into a condo and rented out the family home. You figured you would sell it later when the market bounced back. This is a fatal error unless you filed a specific tax election known as the subsection 45(2) election. This election tells the CRA that even though you moved out, you still want to designate the property as your principal residence for up to 4 more years. But here's the catch. You have to file this election with your tax return in the year the change happened. Most people do not know this. They just move out and rent the place. 3 years later, they sell. The CRA steps in and says, you moved out 3 years ago. For the last 3 years, this was an investment property, not a home. The growth in value during those 3 years is fully taxable. And because house prices can swing wildly, the CRA will demand an appraisal from the date you moved out. If the value jumped during that rental period, you are hit with the exit tax. If you try to file the election late, the CRA charges a penalty of $100 a month for every month it is late, up to $8,000. And they have the discretion to simply deny it. We are seeing thousands of accidental landlords facing massive tax bills because they missed a single piece of paper 3 years ago. Now, we must discuss the most aggressive weapon in the CRA's arsenal, the anti-flipping rule. This legislation was marketed to the public as a way to stop greedy speculators from driving up housing prices. But as with all government overreach, the net is catching regular families. The rule states that if you sell a residential property, including your own home, within less than 365 days of owning it, the profit is effectively deemed to be business income. Note the distinction: business income, not capital gains. Capital gains are taxed at 50% or 66% inclusion. Business income is 100% taxable. And every single dollar of profit is added to your income. You also lose the Principal Residence Exemption entirely. The government claims there are exceptions for life events like death, divorce, or a new job, but the burden of proof is on you. If you bought a pre-construction condo, closed on it, and then realized you couldn't afford the mortgage payments because interest rates spiked, so you sold it 6 months later, is that a life event or is that insolvency? The CRA auditors are taking a hard line. We have seen cases where people sold because of financial hardship, and the CRA ruled that financial mismanagement does not qualify as an unforeseen life event. They are taxing the desperate exit as if it were a profitable scheme. You are losing money on the mortgage, losing money on the commissions, and then the government takes half of whatever equity is left because you sold too quickly. This brings us to the builder's trap, also known as an adventure in the nature of trade. This is a terrifying concept for anyone who has ever built their own home or done a major renovation. You buy a fixer-upper, you pour your heart and soul into it, you renovate it yourself on weekends, you live in it for 2 years. Then, someone knocks on your door and offers you a price you can't refuse. Or maybe you just want to move to a different neighborhood. You sell. You make a healthy profit, you claim the exemption. Then the audit letter arrives. The CRA looks at your history. Maybe you work in the construction industry. Maybe you are a real estate agent. Maybe you have done this once before, 5 years ago. But the CRA argues that your primary intention when buying the house was not to live in it, but to sell it for a profit. They argue that you lived in it just to mask the business activity. They reclassify the entire transaction. It is no longer a capital gain. It is business inventory. The consequences of this reclassification are catastrophic. Not only is the profit fully taxed as business income, but the CRA will also hit you with gross negligence penalties. These penalties are 50% of the tax you tried to avoid. Let's do the math. You made a $400,000 profit. The CRA treats it as business income. The tax on that is roughly $200,000. Then they add a 50% penalty on the avoided tax. That's another $100,000. Plus interest. You sold your house for a $400,000 gain and the government takes $300,000 of it. You are left with nothing but stress and legal fees. This is not a hypothetical scenario. The courts are full of cases where the CRA has successfully argued that a person who lived in a house for 2 or 3 years was actually a trader in real estate. But how does the CRA know? This is the question everyone asks. How will they find me? The answer is that they already have found you. The CRA now has direct access to provincial land registry databases. They have access to pre-construction assignment sales records from developers. They have access to the MLS sales history. But more terrifying is their new unreported income algorithm. They cross-reference your postal code history with your tax returns. If you changed your mailing address on your driver's license, your bank account, or your utility bills, but didn't update your tax status, the system flags a discrepancy. They look at your hydro consumption. We have seen audits triggered because a homeowner claimed a property was their principal residence, but the hydro usage was suspiciously low, suggesting no one was actually living there. They are watching your digital footprint to prove you didn't ordinarily inhabit the home. The concept of ordinarily inhabited is the legal gray area where the CRA wins. To claim the exemption, you must have ordinarily inhabited the home. But what does that mean? Does staying there for 2 weeks in the summer count? Does sleeping there on weekends count? The Supreme Court has been vague, which gives the CRA auditors immense power. That they demand proof. They want to see moving truck receipts. They want to see letters from neighbors. They want to see that you changed your doctor and your dentist to the new area. If you cannot produce this paper trail from 5 years ago, they deny the claim. They operate on a guilty until proven innocent basis. The assessment is issued, the debt is registered, and interest starts accruing immediately. You have to pay the lawyer to fight it, knowing that even if you win, you have lost thousands in legal fees. Let's talk about the impact of the new inclusion rate, because this is the math that creates the 66% tax trap. Before June 2024, only 50% of capital gains were taxable. If you had a secondary property, a cottage or a rental, and you sold it for a massive gain, you paid tax on half the profit. It was a fair deal. But the government changed the rules. Now, for individuals, the first $250,000 of gain is taxed at 50%, but every dollar above that is taxed at 66.7%. This was targeted at the rich. But in Canadian real estate, a $250,000 gain is not rich. That is a standard appreciation for a townhouse in the suburbs over a 10-year period. If the CRA successfully denies your principal residence exemption, you are instantly thrown into this high tax bracket. Your home sale profit is almost certainly over $250,000. This means the vast majority of your life savings is being subjected to the highest punitive tax rate in the G7. And they are retroactively applying a tax the rich policy to a middle-class family that just happened to sell their only asset. This is a wealth transfer of historic proportions. It is stripping the equity from the baby boomer generation as they try to downsize, and it is crushing the millennials who are forced to sell due to mortgage rates. Furthermore, we must address the new reporting rules. A few years ago, you didn't even have to report the sale of your principal residence on your tax return. It was an honor system. That changed. Now you must report the sale on Schedule 3 of your T1 return. You have to list the address, the year of acquisition, and the sale price. If you fail to report the sale, even if no tax is payable, you are liable for a penalty of up to $8,000. But by reporting it, that you are feeding the CRA data machine. You are explicitly telling them, I sold this and I am claiming it is tax-free. This checkbox is the trigger for the audit. It highlights your file for review. If you forget to report it and try to amend your return later, the CRA can reopen your tax return indefinitely. Normally, the CRA can only go back 3 years to audit you, but if you fail to report a real estate disposition, the statute of limitations never expires. They can come back 10 years from now, audit the sale, deny the exemption, and charge you 10 years of compounding interest. So, what is the defense? How do you protect yourself from the exit tax? First, record keeping is your only shield. You need to treat your home ownership like a business. Keep every single receipt for every renovation you ever did. Why? Well, because if the CRA denies your exemption, you will need to prove your adjusted cost base, ACB. The higher your cost base, the lower your capital gain. The new roof, the new windows, the kitchen remodel, those costs reduce your tax bill, but you can only claim them if you have the paper receipts. A credit card statement is not enough. You need the invoice. If you paid your contractor in cash to save the GST, you have just screwed yourself. You have no proof of cost, and the CRA will tax you on the full sale price. Second, be extremely careful with change of use. If you are moving out and renting your home or moving back in after renting it, speak to a chartered professional accountant immediately. Ask about the 45-2 and 45-3 elections. These are the get out of jail free cards that can save your exemption. But they have strict deadlines. Do not rely on advice from your real estate agent or your neighbor. Tax law is precise and unforgiving. Third, avoid the builder behaviors. If you buy a home that needs work, document your intention to live there. Keep emails to your spouse talking about schools in the area. Keep a diary of your renovation plans for personal use. If you sell quickly, document the life event that forced the sale. Was it a job transfer? Get a letter from your employer. Was it a health issue? Get a note from your doctor. You need to build a defensive file that proves your intent was to inhabit, not to flip. Fourth, do not claim capital cost allowance on any portion of your principal residence. It is a trap. The tax savings today are microscopic compared to the capital gains tax you will trigger tomorrow. And keep your home strictly in the personal asset category. If you rent the basement, keep it informal and do not expense the structure of the building. The Canadian housing market has become a minefield. You have the Bank of Canada squeezing you with interest rates. You have the banks trapping you with penalties and negative equity. And now, waiting at the exit door, you have the Canada Revenue Agency holding a bag to collect 2/3 of whatever is left. The exit tax is real. It is not a specific line item on a budget, but it is the functional result of a surveillance state desperate for cash. They are counting on you making a mistake. They are counting on you being disorganized. They are counting on you believing the old myth that my home is tax-free. Do not be the low-hanging fruit for the auditor. Before you list your home, before you sign the listing agreement, you need to do a tax audit of yourself. Look at your history. Look at your utility bills. Look at your rental income. If there is a weakness in your file, fix it or prepare for the fight. The closing day is not the finish line anymore. The finish line is when the CRA assesses your return and decides to let you keep your money. In our next investigative report, we are going to look at where all this tax money is going. We are going to look at the other side of the housing crisis, the rental market. We will expose how landlords are being squeezed by the Landlord and Tenant Board, facing years of delays to evict non-paying tenants, effectively forcing them to subsidize the government's failure to provide housing. The government takes your profit when you sell, but forces you to house people for free when you own. It is a lose-lose scenario for the property owner. Subscribe to Canada Property Watch. We are reading the Tax Act, we are tracking the court cases, and we are bringing you the financial intelligence you need to survive the great wealth transfer. Don't let your retirement be reclassified. Stay vigilant, keep your receipts, and watch your mailbox. We will see you in the next one. This crisis is not just about numbers. It is about the betrayal of the social contract. You worked hard, you bought a home, you paid your taxes on your salary for decades. You accepted the low services and the high cost of living because you believed that at the end of the road, your home equity was yours. That was the deal. The government is now unilaterally changing the terms of that deal retroactively. They are using the complexity of the tax code to break the promise of the Principal Residence Exemption. We are also seeing a rise in net worth audits. This is where the CRA looks at your lifestyle, your cars, your vacations, your home, and compares it to your reported income. If you sold a home and claimed the exemption, but you bought a boat the next month and your reported job income is $50,000, the algorithm flags you. They assume you are hiding income or flipping properties. They will demand that you explain how you afforded your lifestyle. If you rely on the proceeds of your home sale, they will scrutinize that sale with a microscope. The danger is also acute for those who have mixed-use properties. Do you run a business from your home? Do you have a dedicated home office that you claim expenses for? Do you use your garage for your plumbing business? If you have designated a specific square footage of your home exclusively for business use and claimed expenses against it, you may have contaminated your principal residence exemption. The CRA can argue that the portion used for business is not exempt. When you sell, you have to apportion the selling price. The business part is taxable. And again, with the new inclusion rate, that tax bill is punishing. We have to talk about the non-resident trap as well. If you leave Canada to work in the US or elsewhere, and you become a non-resident for tax purposes, the rules change completely. If you sell your Canadian home while you are a non-resident, there is no principal residence exemption. None. And there is a 25% withholding tax on the gross sale price, not the profit, at the price. The lawyer must hold back 25% of the entire check until the CRA issues a clearance certificate. This can take months. If you are selling to move money out of the country, your capital is frozen. The 66% tax trap is the government's way of saying that the era of building wealth through housing is over. They want to decommodify housing, but instead of making housing cheaper, they are just making the exit more expensive. They are trapping capital. This leads to what economists call the lock-in effect. People who want to sell, people who want to downsize, people who should move for work, they don't. They stay put because the tax cost of moving is too high. This reduces inventory, it hurts the economy, and ironically, it keeps housing prices high because there is no supply. You are not paranoid if you think the system is rigged against you. The banking rules, the mortgage rules, and the tax rules are all tightening at the exact same time. It is a coordinated squeeze on the asset class that holds the majority of Canadian wealth. The penalty trap takes your equity on the front end. The negative equity trap takes your future earnings. And the exit tax takes whatever is left in the middle. Protecting yourself requires a shift in mindset. You can no longer be a passive homeowner. You must be an active tax planner. You cannot assume that living there is enough. You must prove it. You must document it. And you must navigate the sale with the precision of a corporate merger. The CRA is not your friend. They are a collection agency with the power of the law behind them. We will continue to uncover these stories. We are hearing from viewers every day who have received these reassessments. One viewer in Vancouver was reassessed for a sale that happened 4 years ago. The interest alone was $40,000. Another viewer in Toronto was denied the exemption because they let their elderly mother live in the basement and she paid rent to cover the utilities. The CRA called it a rental property. These are the stories you won't hear from the mainstream media, who are too busy repeating the government's talking points about fairness. There is nothing fair about changing the rules after the game has been played. Stay with us. Share this video with every homeowner you know. Share it with your parents who are thinking of downsizing. Share it with your kids who are thinking of renting out their basement. They need to know the risks. Bet the exit tax is the silent wealth killer of 2026. Don't let it kill your financial future.